The Van Ketwich fund mentioned in the last video is what we would today refer to as a closed-ended fund. They were specifically limited to having 2,000 ownership units whose price changed ultimately based on the value of the underlying assets, as well as market's demand for these units, as they represented not simply a call on the underlying assets, but also access to the manager who was overseeing this particular portfolio. Now, these funds are normally structured a bit like a corporation. They've got permanent capital, and they don't offer the redemption of units, which is to say, like a corporation, it will generally not buy shares back from its investors on demand. In addition, these kinds of closed-ended funds, much like a corporation, are able to use financial leverage, i.e. debt, in order to amplify their results, whether for good or for bad. Now, ultimately, this means that the price of an underlying unit in the fund might possibly diverge from the sum of the component parts of the portfolio, which is a puzzle in finance that even today is not very well understood. But in contrast to this, we also have open-ended funds. An open-ended fund, what is frequently today referred to as a mutual fund, enables investors to buy in without necessarily having to purchase their units from existing investors, and it allows for exiting investors to simply cash out as they please by redeeming their units and selling them back to the fund. The first investment trust that was organized in this way was the Alexander Fund from 1907. It would create new units every 6 months, as well as redeeming new units on demand for its investors. In 1924, the Massachusetts Investors Trust began to create and redeem units on a regular daily basis, based on the portfolio's underlying asset values at the close of trading on the prior day. Now, the net asset value for a mutual fund, or the value of each of these open-ended units, is fairly simple to calculate. It's simply the sum of all of the fund's assets minus the fund's liability divided by the number of units. And in this way, when new funds are added to a mutual fund or an open-ended investment trust, the NAV of each unit does not, in fact, change, whereas that definitely can happen with a closed-ended unit, which simply has a fixed number of units and a fixed amount of capital. Now, due to these sorts of regular redemptions that an open-ended fund has, an open-ended fund typically has to be much more conservative than a closed-ended fund with regards to the use of leverage. Simply because large investors who ultimately wish to leave the pool would require the fund to sell off some of its leveraged positions, which could, of course, push asset prices downwards. And this allows for, incidentally, a number of these open-ended funds to escape the Titanic crash in 1929 that occurred on Wall Street. In this particular situation, the reason this had been so dramatic for the investing public was not just that the stock market had crashed 30 or 35% in such a short period of time. It was because investors not only were utilizing their own margin, but that the closed-ended funds many of them were invested in had further leveraged their positions. So an investor who thought they were relatively safe with 2 or 3 times leverage, who then bought units of a closed-ended fund, which also used 2 to 3 times leverage, could suddenly find themselves having 4 to 10 times the risk exposure that they would have had by buying these assets on their own. Now, as a result, the need to redeem units of investment trusts caused a lot of people to sell off their units in the 1929 crash, which of course led to very rapid selling among the funds who were trying to meet liquidity requirements in order to pay out these various investors. Nonetheless, following the crash, the United States government felt that it was more appropriate to reform the financial sector as opposed to necessarily banning trading or any such thing. So in 1933, a rule was established that required all funds, all investment trusts, to provide a prospectus outlining their objectives and at least loosely what sorts of strategies they would follow in order to attain them. The following years, funds were required to start issuing annual reports to their investors so that investors had some idea about how their portfolios were evolving and whether or not the risk profiles had changed. By the end of the decade, funds were being required to avoid conflicts of interest. All of them had to have a board of directors set in place, and they all began to face significant restrictions on how they constructed their portfolios, including a limit of 85% or more having to be invested into liquid securities, having position limit of no more than 5% in any given asset, and being limited against the use of leverage except in very specific circumstances. Now, of course, this still leaves a very wide range for public investment funds when they're looking to pursue different kinds of strategies. We still have mutual funds today pursuing various strategies like value versus growth focuses, investment grade versus high yield funds, small versus large company focus, an international versus domestic focus. There are money market funds. There are specific sector funds focusing on things like railroads or mining, healthcare, defense, education, etc. You've got socially responsible funds that are seeking to avoid certain kinds of sectors, as well as balanced funds, which simply put their fingers in every pie they can find. Now, by far, investment funds are the most common way for individuals to invest their funds into capital markets. By the end of 2017, it was estimated that there were about 114,000 public investment funds in the world, more than there were publicly traded companies, and that these funds collectively held in the range of $50 trillion. So it's important for us to take a little bit of time to understand exactly what it is that mutual funds are doing with all of this wealth. And importantly, what kinds of costs are associated with these investment vehicles.